If you are applying smart money concepts on your charts, you are probably seeing dozens of setups that look perfect every single day. But here is the uncomfortable truth. A professional trader would delete almost all of them. And that deletion, not the analysis, is what separates the traders who compound from the traders who bleed. Because the market does not reward activity, it rewards precision. The amateur asks how many trades he can find. The professional asks how many trades he can eliminate, and lets only the rare A+ setup through. In today's video, I am going to hand you the 5 filter system that professionals use to kill weak setups before they cost money, and then show you exactly how to execute the survivors with 3 entry models that position you where the other side of the trade gets it wrong. By the end of this video, you will stop chasing every move and start trading with clarity, structure, and intention. So, if this kind of content helps you, take a second to like the video, subscribe, and turn on notifications so the next lessons reach you the moment they go live. And feel free to share in the comments which topics you would like us to explore in future videos. And if you want to support the channel on a deeper level, consider becoming a member to unlock exclusive content and help keep these lessons coming. You'll also find links to our trusted partners in the description below. Using them costs you nothing, and it directly helps the channel keep producing free educational content like this. Starting with filter number 1, permission. Price must originate from a higher time frame supply or demand area. For a setup to deserve your money, price needs to come from a strong supply or demand zone on a higher time frame, such as the 1 hour or the 4 hour chart. This condition answers the most important question in trading: who is in control of the market? It shows whether buyers or sellers are dominating, and it defines the only direction you are allowed to trade. If you are looking to buy, price should be coming from an unmitigated demand zone on the 1 hour or 4 hour time frame. If you want to sell, price must be coming from an unmitigated supply zone. This is not a detail. If you do not know which side is in charge, you are not trading a setup. You are guessing. And sooner or later, you will be positioned against the real direction of the market. So before moving forward, let's quickly recap how to read control. To know whether demand or supply is dominant, look at the most recent price origin. If the market is trending downward and the move was born in a fresh, unmitigated supply zone, then supply is in control. And the only opportunities you should be hunting are sells, not buys. Supply keeps that control until price reaches a fresh demand zone and reacts upward. The moment that happens, demand takes over, and you stop looking for sell setups, even if something appears that looks like a perfect entry. Control always depends on how price reacts to unmitigated supply and demand, and a fresh, higher time frame zone always outranks the time frame you are currently analyzing. That is why control can flip. If price taps into a fresh, unmitigated higher time frame zone from the opposite side, command shifts from demand to supply, or from supply to demand. And here is why so many traders skip this first filter: recency bias. The last few candles always feel more real than the higher time frame structure, so they end up trading the recent move, while control belongs to a chart they never opened. Now, moving to filter number 2, the footprint test. We only trust a point of interest that was created by a liquidity sweep. The first thing we want to see is the sweep itself, buy side or sell side, followed by a sharp shift in price direction that eventually breaks structure. That sequence forms a high-quality point of interest at its origin, and it creates a strong probability that price will react or fully reverse when it returns to that area. That is our trading opportunity. And the reason is simple. These zones are the footprint of smart money. Price performs a manipulation, taking out the positions of retail traders, and it is exactly there that large volumes change hands, just before a strong move in the opposite direction. That is what makes these zones supply and demand levels that deserve your full attention. So understand what it means when the sweep is missing. Nothing has been taken, nobody is trapped, and there is no footprint. Yet most traders take the zone anyway, because waiting feels like missing the move. That is FOMO placing the order, before smart money has even acted. Now, adding more confluence with filter number 3, inefficiency. The one where most average setups quietly fail. To strengthen the setup, we want order blocks and points of interest that were formed with imbalance. A clear imbalance between buyers and sellers tells you that significant volume was traded there, which is another signature of smart money involvement. And the unfilled gap left above or below the point of interest works like a magnet, making the zone more sensitive and more reliable. Because of that, when price returns to these areas, it is far more likely to respect them. Moving forward to filter number 4, location, premium or discount. Because a good zone in a bad place is still a bad trade. Points of interest sitting at the extremes of the market always have priority over the ones formed in the middle of the range. In a bullish market structure, you focus only on demand zones inside the discount area, the lower portion of the range. In a bearish market structure, you focus on supply zones inside the premium area, the upper portion. This filter alone removes a huge number of weak setups and keeps your attention on the areas with the best risk to reward. And notice where the crowd trades, the middle. The middle of the range is where a trade feels safest, and that comfort is exactly the problem. Because comfort is what the crowd pays for. Discount feels wrong at the moment you click the button, and that is precisely why the price there is still good. Finally, we reach filter number 5, the exit test. There must be a higher time frame liquidity level ahead of price. You need a clear liquidity target on a higher time frame to act as your take profit, a defined destination for the trade. This is the one that saves you from a painful lesson, because even a perfect setup only makes sense if there is enough room for price to actually reach the target. It is what lets you define your entry, your take profit, and your risk to reward with clarity. And it is the final checkpoint, the one that decides whether you take the trade or stay out of the market, even when everything else looks beautiful. Now, let's quickly recap all 5 filters. Filter number 1, trade only from higher time frame supply or demand. Filter number 2, look for liquidity sweeps that create strong points of interest. Filter number 3, focus on imbalance and inefficiency for stronger reactions. Filter number 4, operate in premium and discount zones, not in the middle. Filter number 5, always have clear higher time frame liquidity as your target. When every one of these filters agrees, you are holding the rare setup that survived the whole system, a true A+ trade. But identifying it pays you nothing. Execution does. And execution is a separate skill, knowing exactly where the entry lives and who is standing on the other side of it when you pull the trigger. So now, let's go step by step through the Smart Money Concept's entry methods and learn how to position yourself exactly where the other side of the trade gets it wrong. Within Smart Money Concepts, there are 3 main entry approaches: the aggressive model, which carries higher risk, the conservative model, which adds confirmation before entry, and the ultra-conservative model, which stacks confirmation across multiple timeframes. Each one has its own advantages and limitations, so it is essential to choose the one that matches your trading style and your risk tolerance. Let's break them down one by one. We begin with the aggressive approach. Entering with this model is essentially placing a limit order inside a higher time frame supply or demand zone. Imagine you have a perfect sell setup, just like the example on the chart, fully aligned with every rule of a high probability trade. When placing the short position, your entry sits at the lowest point of the supply zone to manage risk effectively. Your stop loss goes a few pips above the highest point of that zone. For take profit, you can target the nearest external liquidity on the same time frame, since that is the expected direction of the move. Or you can aim for a higher time frame liquidity level and secure a stronger reward to risk ratio. If you prefer a more refined version of this approach, place your entry at the midpoint of the point of interest. That small adjustment often cuts your stop loss distance merely in half, improving your risk to reward while increasing your potential return. The main advantage of aggressive entries is that you are far less likely to miss the opportunity, and you do not need to constantly monitor the charts. The disadvantage is just as clear. You are entering without any confirmation of a reversal, and without watching how price behaves when it arrives at the zone. That is real risk, and it has to be respected. But think about who is filling that limit order. It is the trader chasing momentum into the zone, buying at the worst price on the chart. Entering without confirmation feels exposed, and that feeling of exposure is exactly what the other side of the trade is paying you for. Now, let's look at the conservative entry model in more detail. Here we work with 2 timeframes, a higher timeframe for the analysis and a lower timeframe for confirmation and execution. Personally, I prefer analyzing on the 15-minute chart and executing on the 1 minute, but you can use combinations like the 1 hour with the 5-minute or the 4 hour with the 15-minute, depending on your trading style. The key principle is that your analysis timeframe should be at least twice as large as your entry timeframe. To apply the model, we wait for price to reach the point of interest and show a clear rejection. Once that happens, we drop to the lower timeframe, watch price action closely, and patiently wait for a valid change of character pattern to form. Only after that shift in market structure is confirmed on the entry timeframe do we place the entry at the lowest point of the newly formed order block. In this case, that order block is a lower timeframe supply zone created by the change of character move, with the stop loss placed a few pips above the highest point of that zone. For take profit, we target external liquidity on the higher timeframe. The advantage here is that the reaction at the point of interest is confirmed by lower timeframe price action, which usually means tighter stops and a better risk-to-reward ratio. The disadvantages are real, though. If price invalidates the point of interest and keeps pushing higher, your lower timeframe stop can be hit quickly. There is also the possibility of a continuation pattern forming on the higher timeframe, or price needing to sweep additional liquidity first, and both of those can trap you inside the trade. And the more you refine your entry, the higher the chance of missing valid setups entirely. Understand the deal you are making here. Confirmation buys you comfort, and comfort has a cost, because sometimes the move leaves without you. There is no free entry model. There is only the trade-off you consciously choose. Now, let's move to the third model, the ultra-conservative entry. Imagine a perfect sell setup on a higher time frame, such as the 4-hour chart, fully aligned with every criterion of a high-probability trade. The next step is to wait for price to return to that higher time frame supply zone, and then shift down to a lower time frame, such as the 1-hour chart. From there, monitor price action and wait for a change of character to form. Once that structural shift is confirmed on the 1-hour time frame, the ultra-conservative sequence begins. First, identify the supply zone created by the bearish change of character move. Then, move down to the 15-minute time frame and wait for price to tap into that 1-hour supply zone and form another change of character. Next, mark the order block formed on the 15-minute chart. After that, drop to the 1-minute time frame and wait for price to enter the 15-minute supply zone, reject, and create one more change of character. Once this final confirmation appears, identify the new order block and place a sell limit at the lowest point of that zone, with the stop loss positioned a few pips above it. For take profit, you can target either a higher time frame unmitigated demand zone or the current swing low. The advantage of this model is obvious. Confirmations stacked across multiple timeframes, and entries so precise that the risk to reward often becomes exceptional. The cost is equally obvious. It requires significantly more time and patience, and waiting for that many confirmations means some opportunities will simply leave without you. But notice what each change of character in that sequence really is. Another wave of trapped traders, forced to fuel your direction. Layer by layer, you are entering where the crowd has already been proven wrong, 3 times in a row. The patience this model demands is the one thing that crowd cannot supply. And that is the single thread running through this entire lesson. The 5 filters exist to keep you out of the trades the crowd takes. The entry models exist to position you exactly where that crowd is wrong. So trade less, filter more, and let precision, not activity, build your account. So, trader, if this video brought you more clarity, like it, subscribe, and turn on notifications so the next lessons reach you. And tell me in the comments what you want me to cover next. And if you want to go deeper, you can become a member of the ComLucro Trader community right here on YouTube. It unlocks exclusive content, early access, and extra tools for your development, while directly supporting the channel. You'll also find our trusted partners linked in the description. Using those links costs you nothing and helps us keep producing this kind of educational content. And remember, the mission of the ComLucro channel is simple. We help traders build clarity, confidence, and structure, so every decision is made with discipline and intention. Here you'll find complete courses built as a true trading masterclass. Liquidity, market structure, higher time frame analysis, and supply and demand. Always focused on reading price and executing with a professional mindset. We also cover trading psychology, risk management, and long-term consistency. Because trading isn't just about charts. It's about mindset, discipline, and execution over time. Our main courses include smart money concepts, ICT, technical analysis, trading psychology, and Wyckoff. Alongside that, we share insights from respected traders whose work helps you understand how markets really behave. Thanks for watching, and I'll see you in the next video.